Last night I did a video on the stock market crash and talked about if there were some bargains in the oil stocks because of the big drop in crude oil prices. And I talked and kind of warned about looking to buy these stocks that have these big dividends now, these oil stocks, after they dropped, because when the stock price drops, their dividend yield goes up if the dividend paid out doesn't change. And so because OXY fell 50% yesterday, its dividend yield was then 25% a year, which is crazy. But as I pointed out, because of the low oil prices and that they were losing money last year, and they couldn't pay the dividend, that they were gonna eventually have to slash it. I had no idea that it was going to be within a few hours of that video that they were going to slash their dividend, but here it is. I saw the stock halted this morning, and the news is that they slashed their dividend by 86%, and this stock is down about 80-90% over the year, 80% over the last year. So I want to talk about in this video the risk of these high yielding dividend stocks and how it kind of suckers people in because of the high yielding price. You know, when the US 10-year Treasury note is yielding less than 1%, a lot of people are looking for places where they can get a good yield on their money. And so these stocks that have these really high yields are really attractive to people, and they kind of underplay the risk of why the yield is so high. It's usually because the stock price has fallen so much, because there's real problems with the business. But a lot of people want to overlook that and just hope that this high dividend goes on for a number of years, and usually that's not always the case. And the other thing is that a lot of people have a kind of false sense of security on something like Occidental because Warren Buffett is a big investor or was a big investor in it. He lent them $10 billion last year and has a 8% preferred dividend and is a shareholder, even though on paper he's now down about $500 million on his OXY position. But a lot of people don't want to do the research and to follow a stock because it's a lot of work, and you're only one person. You really can't follow 30 stocks, 50 stocks, and read the annual report and look at the earnings every month and all that. It's almost impossible. So what people do is they kind of try to outsource the research to somebody else. In other words, I don't want to do all this research on OXY or any of these oil stocks. There's 100 oil stocks. How the hell am I going to research all of them and figure out which one's good? Oh, here's a shortcut. There's Warren Buffett, and he's buying Occidental, so he's a smart guy. He must know, he must have done the research, his team, whatever. So if it's good enough for him, it must be good enough for me, and therefore I put all my faith into Warren Buffett's picks. And that may work for some stocks, but it may not work for others. And that's the problem, is that that's what people like to do, is they like to look for shortcuts. And that's why there's so many so-called financial analysts on TV, experts, and even to a lesser extent on YouTube, no less. Just because somebody did a YouTube video doesn't mean they're right and that you should follow them blindly, because they probably know about as much as you do, but you have that perception that because they're making a video and they're giving their opinion and stuff like that, you don't want to do your own research, and so you take the shortcut and say, hey, I watched 3 videos that say OXY is a good stock to buy because it has a 7% dividend or something like that, and so I'm going to go and buy it. And like this guy, it's my biggest position, the biggest I ever had. You know, I hate to see stuff like this. And so, what's the solution to this? Well, obviously, number one is don't look for shortcuts. Don't take a YouTube video as gospel. Um, I'm wrong plenty of times. I'm right sometimes, just like everybody else. So don't go to look to offset your research onto somebody else and say, well, Mr. Warren here, he knows what he's talking about, or some other talking head, or some hedge fund guy, or God forbid, some Instagram influencer telling you to buy some stock or some nonsense like that. So what do you do when you say, because in reality, nobody wants to spend hours a month researching stocks and stuff like that. And so if you want to buy oil stocks, then go buy an ETF or a mutual fund that has a whole bunch of them, and buy it when you think oil has reached its low. Has it reached its low now? I don't know. Maybe it has, maybe it hasn't. That's for you to decide. It's a lot better than it was a few months ago, but nobody can tell for sure, and so don't put all your eggs in one basket if you do. And that's the problem with single stocks, is that if all of your oil investments are OXY and it goes down 80% over the year, that's a huge hit to your net worth. But if OXY is 1 or 2% of your total portfolio, then it's not so bad. And that's why you should diversify with, over 30 stocks, they say, to be diversified by stock name. So that means that if any one stock goes bad, the likelihood that the rest of them will be doing okay won't hurt you too much. And so I would recommend not trying to pick these individual stocks, especially if you're not putting a lot of money to work. If it's just a few $1,000s or whatever, don't waste the time. Just buy an oil ETF or any sector ETF that goes for any kind of sector you're looking at, or even just the market in general. Just go and buy an ETF or a mutual fund, and that way you reduce your risk exposure to any single stock. And so when there's blow-ups like this, it's not going to affect you hardly at all. But I know the trade-off is, if you buy an ETF that has a bunch of other stocks, they don't all have high yielding stocks, and so the yield on the ETF is not going to be nearly as high as some of these individual stock yields. Now XLE is yielding around 6.6%. that's the oil ETF. VDE, the Vanguard Oil ETF, is yielding something similar to that, but it's not yielding 8, 9, 10% like British Petroleum or Royal Dutch Shell or some of these other oil stocks. So don't be greedy, because there is no free lunch. When these stocks are high, it's usually for a pretty good reason. When the comparable alternative investments that are considered safe, like US 10-year treasuries, are yielding less than 1%. So that's the danger of chasing high dividend yields. So don't try to get a free lunch. The dividend yields are high for a reason, and they're much more riskier. So to reduce that risk, buy ETFs or mutual funds. A good general ETF that is the the dividend achievers or the dividend aristocrats is VIG. That's a Vanguard ETF, and although it doesn't have a huge dividend yield, it's companies that have been paying and growing their dividends for the last 20 years. VYM is a bit higher dividend yield, and that is also a Vanguard ETF. So it's not going to pay you 7-8%, but at least you're diversified and your risk is a lot lower, and so you don't have to go around watching YouTube videos about should you buy Occidental Petroleum because it has an 8% dividend or a 10% dividend or 25% dividend. So that's my video on the dangers of buying high yield stocks and what you can do about it to reduce that risk. I hope you liked this video. If you did, give me a thumbs up, leave a comment, and subscribe if you haven't already done so. Thanks for watching.